Ever wonder why two people with the same age can pay totally different premiums for their life insurance? Well, it's not just about the age, it's about what agents don't always tell you that cost you thousands and thousands of dollars. Let's break it down how premiums are really set and how to use that information for your advantage going forward. Here are 5 steps to consider when the agents determine what your premium is. And by the way, folks, pay close attention to 4 and 5, because once we get there and I share the secret sauce, there's going to be a lot of agents that aren't going to be happy, but a lot of clients that are going to be thrilled. So let's get into it. Number 1, age and health are just the start. Yes, your age and health history play a major role, but that's just the beginning. Underwriters look at medications, recent diagnosis, even family history to determine what your class is going to be. So very simply, folks, if you think about it, if you had surgery recently, you want to talk about it. If you drink, if you smoke, you have to bring that up. That could factor into it as well. If you're male or female, that's going to factor into it. Let's say if you are healthy as a horse physically, but you drive like a race car driver and have speeding tickets all over the place, that's going to affect it as well. It doesn't mean you're not going to get it. It's just going to affect it. So it's important you understand these determinations when it comes to your rating and your money time freedom. So number 2, lifestyle and habits matter. I just mentioned drinking or smoking, but listen, do you travel internationally? Are you a pilot? Do you skydive? Do you snorkel? These things play into the risk as well. So you want to be radically honest about everything, but also allow your agent to put together a cover letter that can really put you in front of an underwriter in the best possible light. The less risk posed to the insurance company, the lower your premium is going to be. But that doesn't necessarily mean just because you're a pilot, you can't get a good policy with a good rating and a good premium. And I'm just kind of speaking off the cuff right now, because it does matter what your cover letter looks like. It does matter what your health is, and it does matter about your lifestyle. It doesn't mean you can't do all these things. It just matters you want to be radically honest about them moving forward through the process. Number 3, policy type equals policy cost. And that's what they tell you. Term is cheaper in the short term. But let me just tell you this right now. In the end, when you don't have a death benefit because the term expires, it could cost you millions of dollars later on. Remember, term doesn't build cash value, but permanent policies do. It costs more up front, yes, but you're moving money from one side of the balance sheet to the other, and in the end, it gives you massive tax advantages as well as cash value and lifetime coverage. Agents often push what pays them more money, not what benefits you in the long term. So what do I mean by that? If you're an agent, right, and you don't have a good marketing program and you're done with your family and friends and you're only getting 5 meetings a month, and guess what? If somebody gets a medical done and it takes a blood and urine, it's still going to take 60 or 90 days, whether it's term insurance or whether it's whole life or IUL. So an agent who doesn't have a lot in their bank as far as not money, but in their clientele list, they're going to push the one that's going to pay them the most. And you don't want to be subjected to that. You want to make sure that, in fact, you're getting a policy that builds cash value pretty fast and at the same time dots all the I's and crosses all the T's for you to increase your money time freedom by getting the proper kind of insurance. Number 4, how the policy is structured. Folks, this is important. Grab that pen. Here's what they don't tell you. 2 people can buy the same policy, but one pays more and gets less just because the structure favors, yes, the agent's overall commission. When designed properly, your policy can be optimized for cash value, not just death benefits. So let me stop. There are ways to sell life insurance that they teach us. The way they teach us, I have no problem with. For example, if we sat down and did a cash flow analysis, which, by the way, don't forget at the end, you may want to book an appointment with one of my experts here at Epic to take you through that process. But a cash value analysis is going to look something like this. How much can you save a month? Whatever that number is. Okay, let's put $1,000 a month over here. How much do you do for your 401k? Okay, let's say the person does $18,000 a year. However, the company only matches 4%. So we may say, well, why don't you go up to the match and take that difference and save it over here with the $1,000? That may be another $1,000 a month. So now we're at $2,000 a month, right? And then the next thing would be, well, do you prepay your mortgage? Yeah, I prepay my mortgage by an extra $500 a month. Truth is, if you got a low interest rate and you're prepaying your mortgage by $500 a month, that's basically the return you're getting on that $500 a month. Why not save it over here? So as of now, we're saving $1,000 a month, personal savings. We're redirecting after the match another $1,000 a month. And by the way, we're also redirecting your mortgage, which you're paying an extra $500. Let's put it over here. That's $2,500 a month. Multiply that by 12. Or it's $30,000 a year. But what an agent will do then is take the 30 and put it into a whole life policy. I'm just using whole life as an example, and not allow for overfunding. And also of that 30, they're not allowing what they call a PUA, which would allow a quicker cash value buildup. right? Because you may be the only client they're working on for the next 60 days and they need that full commission, which isn't best for you. For example, if we found $2,500 a month or $30,000 a year, we're going to say something like, okay, how much of this do you want for the short term? How much do you want for the long term? And people usually say 50-50, 60-40, 70-30. So on that $30,000 of $2,500 a month times 12 months, which is $30,000, with us, you'll see 60 or 70% of that money available for cash value. That is a become your own bank policy. That means we make less and you, the client, are better off. Now, you're going to say, well, why would you do that, Rob? And an agent that's going to be mad at me, I got a job for you because we get 800 appointments a month. We love to bring on new agents. So please, you could get direct with me behind the scenes. We'd love to bring you on. Make no mistake about it. But we remove commission because we have so many appointments that in servicing all these appointments, we want to have clients happy, joyous, and free. And we want to make sure that that client is able to utilize that money in the first year for the things they want to use it for, whether it's financing their own debt, buying a rental piece of real estate, or buying other businesses. And the point of all this is not just year one, but to maintain a relationship going forward so we could help clients really feel satisfied about the insurance, no longer think it's a scam, and really change the conversation about life insurance, which leads me to number 5. And this is the last point, the wealth strategy most agents skip. Wealthy families use exactly what I just said, overfunded policies structured with minimal death benefits and max cash to create a private bank. Most agents don't show this because it pays them less. That's the truth. And it builds you wealth faster. When I say less death benefit, I'm not saying like a $10,000 death benefit and putting $1 million in a policy. What I'm simply saying is the way we structure it is you have whole life and inside that you have term, which can convert over time. We like to say, major shout out to Mike V, warehousing the term. From that perspective, though, what'll happen is on top of, remember we just talked about $2,500 a month or $30,000 a year? You could dump it 100, if not 200,000 into that policy if it's designed the right way without making it a MEC. A MEC would mean it's taxable. So these are the things that we look at in order to put you into the right space. So once again, not only on your monthly premiums, right, you're getting cash value built up, but these dump-ins, if you wire it in, you have access to it within 20 days of when you wire it in to use it all over again in the real world. More to come on that. That's a private conversation, so we could explain all that to you. But with that being said and done, it's important you understand the difference between overfunded as well as baseline monthly premiums and how to make those premiums work for you earlier. If you want more personalized advice, because everybody's different, if this video got you thinking and you want real recommendation and strategies based on your situation, click the link below and grab a free consultation with myself and my team or one of my team members. We're going to walk you through what's best for you. No fluff, no BS, no pressure, just a strategy that works for your goals.